Shock Swiss fee hike units markets on edge. BOJ holds Singapore World shares on Friday, headed for his or her worst week on account that market's pandemic meltdown in March 2020, as investors involved approximately boom within the face of worldwide rate hikes except in Japan, in which policy settings had been stored smooth and the yen fell. The Bank of Japan caught with its strategy of pinning 10-year yields near zero at its policy meeting, in stark evaluation to the rest of the arena. Even the Swiss National Bank stunned investors in a single day with its super hike in 15 years. The yen became ultimate down 1% to 133.75 in step with dollar in risky change after the BOJ selection. It turned into little salve for broader markets, which can be mired in worry that inflation and price hikes are going to smother economic growth for years. MSCI's broadest index of Asia-Pacific stocks out of doors Japan fell to a 5-week low, dragged by way of selling in Australia, in which the ASX 200 dropped 2%. Japan's Nikkei fell 2.4%. U.S. futures stabilized, with S&P 500 futures up 0.4% and Nasdaq 100 futures up 0.6%, however they were nursing large losses. Overnight the Nasdaq dropped 4% and the S&P 500 fell 3.3%. We are coming into a difficult phase of the regime shift, as the risks over financial growth add to the already hot inflationary backdrop, said Vincent Mortier, Chief Funding Officer at Europe's biggest fund supervisor, Amundi. The present-day repricing is taking most of the overvaluation out of the market, but present-day degrees are at risk of any deterioration in company fundamentals. World shares are down 5.7% for the week thus far, on path for the steepest weekly percentage drop in greater than 2 years. One-way bonds and currencies had a wild Thursday. As properly because the Swiss hike, the Bank of England announced a 25 basis factor charge upward push, which turned into smaller than predicted, however prompted gilts to sell and sterling to upward thrust on bets that future hikes would come thick and fast. If a relevant financial institution does not flow aggressively, yields and chance fee in more within the way of rate hikes down the road, said NatWest markets strategist John Briggs. Markets might also simply be constantly adjusting to an outlook for better global policy rates, as international important financial institution coverage momentum is all one way. Sterling rose 1.4% on Thursday and held gains into Friday as it heads for a steady week. 2-year gilts rose 18 basis points to 2.143%. German debt became likewise dumped after the Swiss wonder and a European Central Bank plan to direct its bond buying closer to outer edge international locations, before growth fears pared matters apiece. 2-year German Bund yields completed the session up 0.5 bits per second to at least 1.152%, and the 10-year Bund yield rose 5 bits per second to 1.703%. GVD, U.S. labor and housing facts came in gentle on Thursday, at the heels of disappointing retail income figures, with the worries knocking the greenback and supporting treasuries. Benchmark 10-year Treasury yields fell almost 10 bits per second in a single day but wobbled better to a few 0.2253% at some point of Asia's morning. Yields rise when charges fall. U.S. Another element dragging at the greenback changed into the Swiss franc surge, on the grounds that it is used as a funding forex and frequently changed for dollars before those are swapped for excessive yielders, meaning dollars get offered when that change reverses. Growth fears took oil on a short ride lower overnight earlier than prices steadied. Brent crude futures had been last at $118.87 a barrel. Gold held at $1,844 an oz and Bitcoin turned into save beneath strain at $20,600.